Okay, well, my name is Mark Cliff. I'm the Chief Economist of ING, and I'm very proud to open the proceedings today. I think most of you will know that the Geneva Reports are a well-established part of the oeuvre of economic policy. They were launched by the International Centre for Monetary and Banking Studies and the Centre for Economic Policy Research back in 1999. And their focus is on reform of international financial and economic systems. And I think a number of them have been extremely influential in the past. And we're particularly pleased with the latest report, which I think will also be quite an influential one. As you can see, slight change from the invitation. The title is now Banking Disrupted, Financial Intermediation in an Era of Transformational Technology. So we've managed to squeeze in quite a few good buzzwords there. So it's all good stuff. So we're going to be focusing on the financial services landscape and how it's changed over the last few decades. There's obviously a large focus on the issues surrounding big tech and fintechs. And obviously this will be leading us to some important public policy questions about the future of banking. And its key conclusion is that for banks to succeed in the new era, they should embrace technology, partner with tech firms, meet customer expectations, and maintain their trust. So that's easy then, isn't it? So that's what we're going to be talking about tonight. Now, I'm also very pleased indeed to introduce our moderator for the evening, no less than Philip Augar. He's a former investment banker and is very well known to many of you as a prominent author and keen observer of the banking scene. He has a very impressive CV, which I'm sure you can Google and find, but he has been the member of a number of boards in both the public and the private sectors. He holds a doctorate in history and is currently chairing the panel reviewing post-18 education for the UK government. I say for advisedly. One would say perhaps it would be better if it was of the UK government. But anyway, without further ado, I would like to hand over to Philip to introduce our very prestigious panel to talk about the latest Geneva Report. So over to you. Thank you.
Thank you very much, Mark, for those warm words of welcome. And thank you to ING and to the CSFI for hosting and facilitating this event. The running order will be that one of the co-authors of the report, Tara, will speak for, we think, 20 minutes, maybe 30 minutes, running us through the report. There will then be a panel discussion, which I will moderate. And then we will finish with time for a Q&A from a very distinguished and powerful-looking audience. As Mark said, or as Mark implied, I've been involved with the banking industry for quite a long time. In fact, it's over 40 years. And periodically during that period, people ask the question, is this the end of banking as we know it? It happens about every few years. And, you know, we have a little bit of a good debate about it, often at the CSFI. There's a few articles in the FT, and we rapidly decide that, actually, no, it's not really the end of banking as we know it. This time, however, I personally feel that this is very different. The scale and the speed of the challenge that is coming to banks on the wholesale side from shadow banks, and on the retail side and in the underlying architecture from big tech and fintech, creates what seems to me to be an unprecedented squeeze on the banking model and on financial institutions. And so the report, this 22nd Geneva report, is incredibly timely. It poses some really challenging questions. The art of good policy, I think, is always to ask the right question, to come up with a set of answers that will prompt debate, that will prompt policymakers, regulators, and the industry itself to look very hard at what it is doing and how it might respond. This really does feel to me like a fundamental, completely unparalleled set of circumstances, at least in my 40 years. Tara Rice, who joined the biz from BlackRock after a long and distinguished career in US policy, is one of the co-authors of the report. And so initially I'd like to hand over to you, Tara, to take us through it. Thank you.
Thank you, Philip, and thank you very much for the invitation today. Very pleased to be here. My co-authors would have loved to have been here as well, but we're all over the world. So I will speak on behalf of them and bring in a little bit of Catherine's views too. Catherine's the president of Cabbage, a fintech company. And so it's been a fun debate we've had between the fintech folks and the banking folks. All right. So yes, this is together with Catherine Petralia, Thomas Philippon, and Nicola Verone. And about the title, Philip, we had the future of banking at first, but discovered that there are 3 other reports on the future of banking. So we tried to come up with something a little more clever. Okay, so as Philip said, we also believe that the threat to big banks is different this time. They face competition as long as they've been in history, but again, as Philip said, today what's different is the speed, the scale, and the border hopping technology, and I'm going to talk a little bit about that. It's true that there's also competition coming from the wholesale side. We're going to focus really very specifically on the retail side, on fintech and big tech firms. That's just our outline. So being in the BIS, I had the opportunity to go down to the archives, and they have stuff going back to the 1920s. It was great fun to do that. So we started to explore if banks have been under threat for a long time, and in fact, we found articles going back, again, as long as the archives existed, indeed, that they've been quote-unquote under threat. But banks are special. They mitigate problems that would prevent funds from flowing from savers to borrowers. And the modern banks, as we know them, have actually been around since the 1600s. Great. Okay. So the size and the scale of big banks has enabled them to engage in large-scale international transactions, such as the financing of international trade. And again, going back to the 1900s, we've seen record of this. They've also historically been linked to their sovereign. I'll talk a little bit about that as well. And by the way, this picture is also from the archives. It's from 1925, the Royal Bank of Scotland. So big banks, they're not the same as small banks, and you know as well as I do what activities they're engaged in. They do international financing, cross-border payments, international trade, also provide services such as investment banking, securities brokers, insurance agency, underwriting, asset management. But I'm going to show you that despite all the advances in technology and financial innovation, banks are still banks. They're still doing largely the same things. So this shows large banks, small banks, and the median banks. So what we've done here is the 90th percentile of banks is the banks by assets in the 90th percentile. So think of them as the very largest banks. The red line is the very smallest banks, and the yellow is the median. So here are loans to assets. As you can see, the small banks and the median banks have about the same ratio of loans to assets, about 65%. The largest banks, to our surprise, actually has more than 50% of their assets in loans. Same goes for the deposit side. Small banks and the medium banks look very similar. About 70% of their deposits, or their assets are deposits. Also interesting, though, that with the largest banks, 60% of their assets are deposits. Not assets, but. Same sort of story on the revenue side. Interest income is larger for the smallest banks, but still significant for the largest banks. Non-interest income, other way around, so the largest banks earn more non-interest income or fee income than the smallest banks, but not by a significant amount. And what's also interesting is that this is very stable over time. Okay, so how about, let's look at things from a broader perspective. Here's a chart that we reworked a little bit from McKinsey & Company. This shows annual revenues of financial intermediation, so it's all firms in their global universe. The red bars are stuff related to, activities related to traditional banking. So consumer finance, retail banking, corporate and commercial banking, and then payments we looped in there as well. 80%, if you include payments, 80% of banks' revenues come from traditional banking activities. With the study, we also ran a survey. We surveyed big tech, fintech, and large banks and non-bank firms. We got about 60 responses, which was, I thought, great for a voluntary survey. But we asked them lots of questions on competition, product offering, and we also asked them some free text questions. So basically, like, what do you see as the future of banking? There's a large box in the report that shows some of the quotes. We were talking about it earlier today. What was interesting about the free text comments was that from the banks, the large bank side, they were very optimistic about their futures and how technology could basically, transform their business in many different ways. So take a look. I'm not going to quote any here, but they really saw technology affecting every part of their business, from the consumer to the back office, cloud, AI. They had all kinds of ideas where they were going in the next 5 years. But this chart shows, first, in the top left-hand corner, products and services affected by technological development. So we gave them 10 choices, and they just had to rank them. We asked them, what are most affected now by technological developments, what are most affected by competition, and what are likely to be most affected over the next 5 years? The answer was payments, payments, payments. That was where everybody saw the most disruption, and clearly we're seeing it. We've got the elephant in the sandbox today, wanting to create a Libra coin, but there's lots of other competition out there. The next most important products and services were in terms of retail lending, customer management, customer and channel management is what we called it. So basically, the user experience. And then BI and data analytics, which is kind of hard to see. It's the third one down up top right, and it's the second one down over the next 5 years. So both banks and fintech and big tech firms are really trying to think about how business intelligence and data analytics could improve their businesses. All right, so we've talked just a little bit about banks. I've argued that banks are still banks. They're doing more things now, but they still largely look like the banks that we've known all along. So let's just look quickly at fintech and big tech. Well, fintechs, and Catherine Petralia is a big proponent of the fintech model. So she and I would kind of spar back and forth. She contends that fintechs offer speed and customization that banks just can't offer. She says you can do instant bank onboarding, you can do instant loan decisioning, you can see custom views of historical spending and expected future spending. She says they have really nimble technologies and platforms, they can change in a minute, they don't have any legacy systems, they're no slow to update legacy technology, they're focused on automation, data-driven decisions, they're able to serve early adopters, and they don't have to contend with technology adoption laggards. So this is something that Cabbage created. It just shows how they see the traditional bank process. Everything goes to sort of like some personal decision making, and the fintech firm, basically the customer there, the little green person, gives consent to unlock the data, and boom, decisions can be made. And that's actually how they've built their model. You provide your sort of business data to the firm and give consent, and they review all of your spending and business decisions, and within 10 minutes they can give you an answer, yes or no, on a small business loan. I thought this was cute. So this is a day in the life of a fintech-enabled caterer. It just shows, like, basically from the time they wake up to the time they leave work, everything they do is electronic. There's no paper. So traditional bank products are what we know. This is a suite of products. They're standard, they're non-negotiable. Risk modeling for customers is based on a limited profile, and there's fixed manual underwriting. This is sort of how things have been done for a long time. Fintech today's stirring things up. They've got a suite of products that they can customize. They've got some industry-specific underwriting models, so they're much more like specific to what they're doing. It's not a big pool of loans to underwrite. They're looking at one specific model, and I'll give Cabbage's model again. They're looking at people that want small business loans for like $250,000 less. They know exactly what they're looking for because that's what they do. And fintech in the future, if we go back to talking about big data and AI, we may be in a place where we've got dynamic product offering optimized for specific customer use cases, models that predict customer needs, and ongoing access to data to allow the product to respond to customer in near time, real time. All right, big tech offers scale and scope, right? They've got huge networks, lots of users, and lots of data. And the BIS this year, their annual report, did a nice chapter on big tech. If you haven't seen it, they've got a nice little image about how big tech use their data. It's called DNA. It's data, network, analytics. Data, network, analytics. So you gather the data, you use that to figure out how you can increase your network. You do more analytics on it, you get more data, and this goes around until it spirals until you get a bigger network. So some of these tech firms have very large networks, and they're starting to offer all kinds of different financial products, specifically in China, where payments by the big tech companies accounts for 16% of GDP. All right, so we've got in the report a little table that looks at advantages and disadvantages of banks vis-a-vis their competitors. So let me just get to that. This is just kind of a way of trying to sort out where banks may have little elbow room, little advantage. We kind of know where big banks do and where fintech is. So the red X's are a disadvantage, of course. The checks are an advantage, and the black squares, we thought they were either neutral or in the midst of change, and we really didn't know. They could be sort of the tipping point, for example. Okay, sorry. At one point, these were green. So big banks, you see, have an X on technology. Fintech and big tech, we gave big checks for. Customer experience. Well, for big banks, we thought that's right now in the midst of change, right? It's really going to depend on how they are able to keep that customer. Fintech and big tech, we gave advantages to. When we get to size and scale and scope, that's where things get a little interesting. Big banks, we argue in the book, have advantages in cost of funding for a lot of reasons. There's a long description in there. And also because of network effects. Okay, big tech has large networks, but we shouldn't forget that big banks have networks as well. They have networks, for example, through their branches. They still have a brick and mortar office there, and it brings people in maybe to make a deposit and perhaps choose other products and services. Fintech and big tech, no cost of funding advantage in the same way that banks have. Network effects, fintech, not yet. They're not able to use or don't have those network effects that big tech has, and we gave them 2 checks. Regulation is, it's a big question mark in a lot of areas. So big banks, you could argue, with the post-crisis reforms, have actually a lot of regulation at this point, which may even be a little bit burdensome. However, it's regulation they know, and over the last 10 years, banks have largely built up compliance and other sort of regulatory processes and systems. So you could go either way on that. Fintech, on the other hand, in a lot of cases has to play in the same sandbox as the banks, with regulation that's not necessarily tailored towards them. So Catherine, for example, would argue that they're doing a lot of this stuff. They're doing only 1 or 2 things that banks do, which is just small business lending, but yet they have to comply with the whole suite of regulations that banks do for stuff that they're actually not doing. Big tech is pretty light right now in regulation, and we're seeing the debate in the US and in Europe as well with regard to data protection, antitrust, et cetera. So we may see that changing. Big banks, I'll just go through these quickly. Big banks know how to protect their data by and large. It's very important from a regulatory standpoint of view. FinTech, not so sure, and big tech certainly's not gotten good marks on this, especially lately. And the last thing that we argue in the paper is about political and lobby power. So big banks have been working with our governments for a very long time. At least in the US, there's a very strong lobby, for better, for worse. But they all are able to in effect, work well and sometimes get things to go their way. Things aren't going so well for the big tech companies right now. They're spending a lot of money on lobbying in the US, but so far I haven't seen a lot of positive effects. So there's been lots and lots of stuff in the news about both scandals and, news about fintech and big tech stirring things up. Okay, here's something on scale and scope. I won't go through this too much, but I just wanted to point out this chart down here, which I thought was pretty interesting. So this is taking the assets of the top 10 banks, very, very top 10 global banks. This is from the banker data, over global GDP, World Bank global GDP. Going back to 1970. So back in 1970, the 10 largest banks' assets as a share of global GDP was 5%. By 2008, 2007, it had grown to over 40%. And then, post-crisis, it started to decline, and now it looks to be sort of going sideways at about 35%. What's interesting to me is that this could be the result of several factors, and I'd love to do some more research, figure out what those are. But the most likely drivers are going to be the deleveraging that's been going on post-crisis, number one, the pause in merger and acquisition activity that's been going on post-crisis, and with a big question mark, perhaps also those too big to fail reforms have been successful. At least in the US, when the Federal Reserve was doing its FBO rule, Reg YY we call it now, so that's the Foreign Banking Organization rule, it now does require foreign banks that are above a certain threshold to form an independent holding company in the US. It originally captured about 20, but by the time the rule was enacted, there was only 13. So in other words, a number of banks shrunk their assets, at least in the US, to be able to avoid the FBO rule. So Thomas has done quite a bit of work on market shares. The point of this, without going into a lot of detail, is that finance historically has been characterized by very concentrated shares and relatively little turnover. Europe caught up with the US in the crisis, and it's become even more persistent. But the global players have changed. So back in the 60s through to basically to the 90s, Japan was the quote unquote, the largest banking power in the world. Tides have really turned. Now we see UK was up and down, and the US has always been relatively stable, but China has really grown. China's the red line. So while market shares are relatively concentrated and relatively stable, the global powers have changed. Okay, so what does the future hold?
As long as you don't wait a minute.
It's going to depend on whether, we argue, it's going to depend on how banks adapt to customers' changing demand. Really, it's going to be about making sure that the banks can meet the customer experience. We all have our phones, we all expect mobile first, digital, everything, especially the younger generation. So big question is whether the banks are going to be able to keep up with that. It's going to depend on how the competition chooses to interact with the banks. Are they going to partner, or are they going to really try and compete? It's going to depend on the current state of the technology environment and the financial system in individual jurisdictions. So you'll see some jurisdictions like China or Africa where they've just sort of leapfrogged financial sector development. And it's a much more technological-based system now than it was even 10 years ago. And finally, how the regulators and policymakers across the globe respond. In the end, it's going to be customer choice. So I said at the beginning, banks have survived many evolutions, but there may be some reasons why it's different this time. Big banks are more or less in check thanks to post-crisis regulations. Consumers are ready, and big tech's around the corner. We've got a couple of charts and a couple sections in there talking about specific geographical challenges. I'm not going to go into a lot of those in detail, but we cover both the challenges I'll go back to that, in China and in Europe, which are very specific to both of those geographies. And here, for example, you can see that the price to book in Europe and other countries has declined over time. But there may be some hope on the horizon. So for a very long time, the unit cost of finance has been very expensive. And it's been very sticky. It hasn't moved really at all. But finally, this is based on Thomas's work, his updated estimates show that it may be starting to decline. Just maybe starting to decline. That would be a welcome. That would be a welcome change. It would mean that the customers find their products and services cheaper. It may be better for financial inclusion. It may be the result of fintech and the competition from fintech and be able to go to some of these more digital products and services. But big tech still looms. This is the market capitalization of big tech versus major financial groups. Valuations of big tech are 3 to 3.5 times the largest banks. In other words, a bank inside a big tech could pretty much dwarf any other institution if we were to let it. Well, a big question really is then we ask, are we going to let it? Are we going to let a big tech have a bank? Well, no big tech companies have applied for a bank, at least in the West. But in China, both Ant Financial and Tencent have banks. E-money licenses, I should say. I would say that China was pretty, the Chinese regulators were pretty open to that development. But when things started getting a little bit, when there started being some problems in like P2P lending and a lot of the financial services was going outside the regulated perimeter, they brought them back in a couple of years ago. So we'll see how this develops in the future with China, but at least in the US, I don't think we're going to see any banks anytime soon. I'm doubtful of it here too. We point to a couple of examples where large retailers, large firms, tried to obtain a banking license. And the most well-known one in the US was Walmart's bid in 2004 of getting an ILC license. For those of you who don't know what an ILC is, it's an industrial loan company. It's a special type of bank charter that people see as kind of regulation light. And there's a lot of companies, like BMW has one for their financing services. They do sort of their auto leasing and credit cards. Target has one. There's about 20 or so in Utah where they seem to be. So it was denied. It applied in 2004. It was denied in 2005 based on a very broad coalition of Congress, small banks, large banks, retailers, all kinds of merchants. Just basically, a lot of different parties came together and said, no, we don't want this. It ended up, in Dodd-Frank, there ended up being a 3-year moratorium. The moratoriums ran out in a couple years ago, and 2 companies have now applied for an ILC license, Square and Sophie. So the debate's reignited. We're still watching it. I think it's going to be very interesting to watch because this tells kind of what the mood is in the U.S., at least for allowing these sorts of things. So what's different now? We've got 2 things that could change how banking is done. We've got open banking, at least in Europe, and in other countries, not yet in the U.S., and the idea of data portability. What this means is if you have an account here, you can take that account and go to another place. You can go to, you can take it to a Revolut or a small challenger neobank. You could take it to another bank. This means that customers are really going to have a lot more choices. There's a good side and the bad side of that. It means banks are really going to have to try and keep those customers. They're going to have to work harder because those customers are going to be less sticky. So I'm happy to talk a little bit about Libra. We've been doing quite a lot of work on it. Most policymakers would say it's a salutary wake-up call because Libra comes and they want to create a global payment system. That all sounds great, but it has the potential to become globally adopted very quickly. With 2.4 billion users, it could quickly go to scale. If it goes to scale, how would it be regulated? They weren't initially clear on that. There's a little bit more clarity lately, but if you've been reading the news, you know that there's still a lot of unanswered questions about it. But basically, public authorities have started saying, and you can saying out loud in speeches and public remarks, that what it means is the payment systems that we currently have are not sufficient. If a company such as Facebook could come and say, we can do this better, cheaper, faster, and get to more people, it means basically that central banks are not doing their job. So there's a big push actually by policymakers to try and figure out what they can do better. That was the wake-up call part. The risks of this sort of globally adopted payment system are enormous. AML CFT compliance on such a system will be addressed, but it's unclear exactly how it would work. In some cases, data protection, consumer and investor protection, competition, antitrust policy, tax compliance, market integrity are just some of the risks that have been raised with the Libra proposal. But as I just noted, it highlighted authorities' need for a globally consistent view on how to improve payment systems, exchange data, and protect consumers. So I'm going to skip Europe and China. And just two more left. So the big question that we ask, well, two big questions. Is the global architecture up to the task? Banks are being squeezed, as Philip noted. There's lots and lots of challenges to address. We've got powerful pressures right now towards fragmentation. The policies that were put in place post-crisis have been very effective, but it has resulted in some fragmentation. We note in the report that there's a difference between intended, sort of unnecessary fragmentation and that which is intended. And what we really want to avoid is the unnecessary, unintended fragmentation. Inevitable is the word. Finally, we raise a question of whether there is a case for supranational supervision. For banks, probably not, but for other areas, there may be. One area is for data protection. There's a lot of work to do in this area, and as we collect more and more data, as big data, machine learning, AI becomes more and more important in how businesses do things, how we're protecting that data is going to be even more important. The case that we cite in the report is the European Union, it's a banking union. So it's still a partly unfinished project, but 10 years ago, 20 years ago, the idea of a banking union in Europe would have been like unthinkable. So the fact that we've come this far suggests that there may be scope for thinking about some type of supranational supervision or cooperation. That's just a thought to keep in mind. Okay, so finally, is this the death of banking? We argue again in the report that the speed, scale of adoption, border hopping technology are really, really presenting a fundamental challenge. This competition, we feel, is going to create a radical transformation for the consumer. We really are going to see things done differently, easier, more mobile, quicker. It should reduce costs, should make things faster, should make them more efficient. We argue that because of the historical things that I noted, and there's more description in the report, that banking and their sovereigns are so closely linked and have been for so long that we don't think that's going to change. Banking, we think, will remain a business that's going to be conducted primarily by government chartered and regulated entities. But it's going to really depend on banks' ability to meet customer needs. And there's a role for public authorities too. Finally, our desired outcome is that public authorities and banks enable better banking. Thank you.
Thank you, Tara, for that tour de force of a fast-changing, dizzying world. You mentioned a couple of other reports, or a couple of reports called the Future of Banking. The two that spring to mind, I particularly recommend a Bank of England report from June called The Future of Banking, and there's a current FT series of the same title. With your own report, that gives a wonderfully complete picture. But the first respondent, distinguished professor on my left, Professor Thorsten Beck, Professor of Banking and Finance at Cass University. Thorsten.
Yeah, thank you. Okay, well, first of all, thank you very much for the invitation to speak here. And
what I will not do during the few minutes that I have, I will not sing the praises of the report, because you have 4 excellent authors, you have an excellent report, as Philip just mentioned, very comprehensive, thought-provoking, lots of interesting anecdotes and data and quotes. So to the students, required reading. What I want to do, rather, I want to kind of, I'm not going to comment on the report either. I want to just give some additional thoughts and ideas that I got partly from reading it or partly I've thought about myself and from discussing with other people, and it might kind of expand the discussion a little bit along some of the dimension that Tara mentioned. But at first, of course, my first thought that came to my mind when I saw the title, the original title, Future of Banking, is something that we did at CEPR 8 years ago, almost on the month, October 2011. And yes, the future of banking is not what it used to be. And actually, it links a bit to what you had in your penultimate slide. In 2011, we were calling for what is now called banking union. I'm not sure the word banking union was already known back then, but we were struggling with this kind of post-crisis regulatory reform things. Now we have new sets of challenges, and I guess even without these big tech, fintech, regtech, and so on challenges, I think the banking system, especially in this part of the world, has definitely a lot of challenges ahead. But I want to talk more about fintech, big tech, digital innovation, and so on. So first of all, of course, financial innovation has been around forever. I mean, since there has been finance, there has been financial innovation. And there are lots of very good history books on it. Just to mention, new types of financial intermediaries are popping up once in a while. Investment banks to finance the railroad expansion in the US, venture capitalists in the 20th century, money market funds to overcome certain regulatory constraints and to kind of move certain activities outside the regulatory perimeter. But even technology has been around for some time. ATMs have been one of the triggers for the branch deregulation wave in the 70s and 80s in the US, kind of helped break up these local monopolies in the US banking system. The IT revolution by itself has led to new kind of lending monitoring screening techniques, such as credit scoring, for example, and an area where I do quite a lot of work in financial inclusion. Mobile money has been kind of allowed several developing countries to actually leapfrog the kind of the expensive mortar and brick branch network to kind of reach out to larger parts of the population. So financial innovation has been around for a long time. The question is this time different? And yes, I would agree. It is somewhat different. And I think to start with the D and the A of the DNA, more data, even more data than before, and data that's not that directly accessible for banks. It's mostly outside the banks in these so-called big tech companies, the Facebooks, the Uber, the Google, and so on. And of course, a new way to analyze data, which also might imply that you don't have to develop your own scoring model, but you have basically analytics in the background developing the scoring model, and also even using data that we still consider as kind of soft data, hard to quantify. Maybe even they can be kind of hardened. Most importantly, and that's the N in your DNA, so I didn't know about the DNA before actually, until like 10 minutes ago. The N, of course, comes from these big tech, these huge companies with that have these enormous networks, which allows them, of course, to kind of grow to this enormous size and then kind of reach out across different types of services. I mean, Amazon is, of course, one interesting example how they have gone from one sector to the other. So there will be definitely lots of disruption, and of course, especially in the retail sector, we've seen that already happening. I think that's probably, as you said in your report, the one area where we will see most of that. Now, one thing I want to be a bit cautious about, and here I kind of also use the chance to just highlight a little bit of my own research. Will we move completely to D&A, to data and analytics, to only hard information? Are we going to take out the human factor completely out of banking? And I'm not quite sure about this. So one, for example, there is research that has shown that during the crisis, clients linked to relationship-based lenders or lenders that actually kind of rely on soft information have fared better than clients, borrowers that have relied completely on transaction-based lenders, so that lenders that focus only on hard data and hard assets. So that's one. That's kind of the data side. On the anecdote side, I just remember like a week ago, 2 weeks ago, I had to call on my credit card because there were some suspicious transactions. I couldn't do it online. I had to talk to 10 people and was kind of transferred from one to the other. Of course, also an issue of legacy banking in the UK, unfortunately. And then finally, talking about scandals on a very low level, there is this case of N26, a German startup bank without any branches. And there was this poor customer, an expat in Berlin, whose account was suspended. He didn't have access to his money. He called them again, went online, they couldn't help him. Eventually, he figured out where the headquarters is of this bank. So he thought, well, he just stops by and asks them. Well, they called the police on him. So, I mean, so much about customer service in some banks. Okay, I understand, as we say, data is not the plural of anecdotes, obviously, but I don't think we can take out the human touch completely out of banking. So that's the one point I want to make. The other point I want to make, which is related to that, we always think, and actually, this what you had on one of your slides, this dynamic fintech approach. We kind of see it always as positive. And that's how I, professionally speaking, also grew up. More is better. We want to have financial inclusion. We want to have people be able to build up their reputation by doing lots of stuff. And then we can take this portability, our information, and take it to a competitor and get a better deal. That's one of the ideas. So kind of lowering the financing constraints, as we like to call it in academic speak. There's another view, and that is that this data might also be used for another purpose, to extract consumer surplus, to kind of target offers straight to the specific needs and the specific literacy and the specific expectations and maybe discount factors of clients. And there's some interesting work by Antoinette Chua from MIT, who shows basically credit card companies in the US are actually exploiting this by they kind of sending one kind of back-loaded offers, credit card offers to some kind of customers, potential customers, and front-loaded offers to some other kind of customers, kind of based on what how they expect to react and how they expect to use the credit card. So this can be also, some people would call it maybe consumer abuse, but definitely it might not be in the best interest of the consumer. Now you can see this kind of what they call scrounging is going on anywhere. I mean, even with like pharmacy medical ads, maybe not in the UK, but in other countries where you can buy them easily over the counter, or you have to pay for them and therefore you buy them. But of course, finance is special because of the intertemporal character. So this kind of myopic behavioral effect comes out much stronger. And with big data, it might actually get worse, especially if you have big tech, big network companies, platform companies using them. So, almost done. What is the policy implications? So on the one hand, we have the regulatory sandbox. We like that because we like innovation. We want to have contestability. And especially if, like in the UK, we talk about challenger banks, we want to have new ideas coming in and kind of mixing up the whole banking sector. That's good. But we also don't want to have too big to fail. And the problem, of course, with platform firms, like with these networks, is that it's kind of a winner takes all, right? I mean, there is only one Facebook. The other one, what was it called? People? No, there was this other network, social network. I forgot what it was called. That went under, right? So there's only one winner left. Similar with Google. Maybe Uber not, but or PayPal. So there's like kind of winner takes all, and that of course makes it too big to fail a bit of a tricky issue, and it also makes the issue of disruption another tricky issue as the system kind of goes from one equilibrium to another. I mean, you talked about 4.2 billion Facebook users. If I asked my teenage boys about Facebook, I'm not going to quote you the answer that I get from them. So because they wouldn't use it. They wouldn't use Facebook, right? So there might be kind of a transition from one to another, lots of disruption again, as we know it from the digital industry. Well, what happens with if they're active in the financial sector? So that's another issue. And then finally, of course, so the regulatory parameter comes in. How do we deal with these big techs? And of course, I think consumer protection will take a much bigger role going forward, given these huge data issues, given data leakages, given data portability, but also even the possibility of actually using the data for purposes that maybe we have to be a bit careful about. So, future of banks or future of banking? I think banking, what is a bank? A bank, as you said, the business model hasn't changed much, but I think the form of banks has changed quite a lot. Right? We don't have much private bankers around anymore. We have now all limited liability banks. But of course, so the form will always change. The quintessence of financial intermediation, as you pointed out, will always be there. This liquidity maturity transformation, this kind of screening monitoring effect. I think it will always be there, maybe in a different form. Another maybe positive thing, so we in finance don't talk much about it. There's actually a field called financial sociology, and they talk about a lot about financialization. So the society is being taken over by the financial sector. I think some of the people in the room might not want to hear that, but maybe, just maybe, we're moving from an era of financialization of society to an era of digitalization of the financial sector. So there's some of this, the overmight of the overpower of the financial sector is being kind of pulled into another direction. And maybe that's also not necessarily a bad thing, or maybe it gives some more equilibrium. But definitely it makes for very, very interesting times to research and to write about it. Thank you.
Thank you. Interesting times indeed. And our second respondent, Teunis Brosens, here at ING, digital finance and regulatory specialist. Thorsten, to you.
Indeed, let me join Thorsten in complimenting you for this great report. I hope you can hear me. And it's not only, I think, required reading for students, but I would say also for bankers. This is really a report that we should all read. I am also, I should. This may be better. Yeah, there we are. Bankers and technology, it's hopeless. Speaking of that, I'm also going to, before talking about the future of banking, I'm going to show you the future of talking, which is not so much talking in front of a crowd, talking from paper, because ING is so digital that I was forbidden from printing my notes here, so I'm going to read them out to you from my mobile phone, where I have them. So I'm going to offer you a few thoughts that really triggered me in the report, and I think the first one is that, I very much agree with the top items that are up for disruption. Payments first, of course, payments, and then a few more, user experience, retail lending. And I also very much agree with the fact that the main task for global regulators is to cooperate. To cooperate more, not only across borders with their own peers, so prudential regulators with other prudential regulators, but also, and this is mentioned in the report indeed, across competences. So prudential regulators should engage with competition regulators. They should engage with data privacy regulators. And I think the launch, or the announced launch of Libra has really also accelerated this cooperation and looking across borders, both from a really jurisdiction perspective and a competence perspective by regulators. To name one example, I was really quite surprised that, I think it was in early August, a number of global privacy regulators issued a joint statement on Libra, and they spelled out, these are our expectations that Libra will have to comply with. And so this was, I think, the first time that privacy regulators, in fact, came forward from the UK, Europe, the US, Canada, Australia, and some other countries, came forward with such a joint statement. So you really see that when confronted with global challenges, in fact, regulators are already driven in each other's arms. And I think that's a very good development from a regulatory perspective. Still, it will be a challenge, because indeed cooperating at a global level, especially today, is a difficult thing. And then you already mentioned it in your conclusions, and I think when I read the conclusion of the report, it really reflected to me maybe the fight or the tensions that were going on behind the scenes, perhaps between the more bank-minded people that were writing the reports and the more fintech-minded people, because I think it read somewhere, well, indeed, banks will prevail because they have this more or less symbiotic relationships with governments. And I read that and I thought, whoa, oh, that's well, I'm glad to hear. I work at a bank, but I'm not fully certain whether that's the case. And then indeed the text went on and said, well, there is an alternate outcome, because in the end it is about the user experience and it is about who is able to capture the primary customer relationship. And there, big techs will be a major competition to banks. And I think really this battle is going on. It will intensify in the years ahead, and the jury is still out who is going to win there. But I think one important element here when you look at big techs and banks is not only the question, will big techs be allowed to become banks, but also will they in fact even desire to become banks, or will they desire to acquire banks or acquire a banking license? And I think there are reasons why they may not want to do this. For one thing, China shows you very clearly that you can, as a big tech, get very far without a banking license. And you can offer payment services, you can in fact offer lending, you can offer a form of savings by a money market account or an investment account. So in fact, in a world where it is about having the primary customer relationship, then you are able to offer quite a number of services that resemble banking and that to a customer look like a bank, talk like a bank, and quack like a bank, but that are in fact not covered by a banking license. And I think this may develop into something that could be a point of concern also from a regulatory perspective, that we will have conglomerates developing. I mean, to be fair, in the Western world, we are nowhere near this point yet, but China is showing the way. And where big techs are building basically a financial conglomerate, which does many of the things, or maybe all of the things that a bank does, but that is in fact not a bank, and that is not regulated as a bank, and that is outside the regulatory perimeter. So that from a financial stability perspective, from a microprudential perspective, regulators lack the tools to deal with such an institution. And that is something I think where really progress is needed on the regulatory front. So that's one reason why big techs, I think, won't apply for a banking license tomorrow. They can do easily without. And also, I mean, why would they not leave the plumbing to the banks? If indeed the world in the future is about having the primary customer relationship, if that is where the value is, because that's where the data is being generated, that's where the customized offers can be made, that's where the surplus can be grabbed, if you want. If that's indeed the case, then why not as a big tech focus on that and say, well, this plumbing of the payment system and of actually taking a loan on a balance sheet after having issued the loan, why not leave that to a dumb pipe, as it's sometimes called, or leave that to some balance sheet that used to be called a bank. They will get a small fee for the favor, and we will have the fun of interacting with the customer. So in that sense, there is a chance that banks are relegated to the plumbing of the financial system. To be fair, for some banks, this can be an actual business model. Right? There is, for example, in Germany, a bank, Solaris Bank, which has made its business model of offering white label banking services to other institutions. So it can be a business model, but I doubt whether it's the desired destination for all banks. So is all hope lost then for banks? Well, no, I don't think so. I should say, he would say that, to paraphrase what's often said about Brexit experts, they would say that, wouldn't they? So a banker would say, of course, that not all hope is lost for a bank. Banks have time to adapt to the new situation. Yes, we are lagging in terms of legacy technology. We don't have the big resources that big tech firms have. However, we have time because banks still have the trust factor. Yes, Facebook is big, but as you indicated, that may be transitory. It may have come quickly, but it may go quickly. While banks have been around for decades or even centuries, and they still have this trust factor. And that may fade over time, but we at least have still a few years to take advantage from that. Also, there's regulation. We have experience with prudential regulation. We have the apparatus in place to deal with prudential regulation, to deal with compliance. This is also something that big tech firms don't have. And indeed, you mentioned that for fintech firms, it may be difficult to deal with the full burden of banking regulation. Well, you could say for banks it's an advantage that we are used to dealing with that, although I don't think everybody within the bank would agree, because the downside is, of course, that if as a bank you want to innovate, then you're also confronted with this full banking license and the full burden of it, while some fintechs that may have just an e-money license or a payment institution license have a much lighter regulatory regime. Maybe working towards a conclusion on data. Yes, there are dangers of data, but there are also, I think it's important also to broaden the data sharing that's now being applied to banks, so open banking here in the UK, to level the playing field, give banks also an opportunity to get data from Google, obviously subject to user consent, but at least so that we have a level playing field, that we have all the data, the same data available, and we can, as banks, also offer services based on those data. Yes, and my final remark, I think maybe on fragmentation, I very much agree to the point that we should avoid unnecessary and unintended fragmentation. This goes for regulation, and it is in fact something that we already see happening in Europe, because yes, for banks we have a consolidated regime, the banking union, and the ECB as the lead supervisor. However, for a lot of fintechs that are still operating under an e-money license or a payment institution license, yes, the regulation is European. However, the implementation of the regulation is national. And so you have, what is it, at least 27 supervisors dealing with e-money institutions, payment institution licenses. And if you take together prudential regulators, data privacy regulators, anti-money laundering regulations, it's a multiple of 27. And to ask a rhetorical question, is it real, or can we really expect a small supervisor in a small country somewhere in Europe to really develop a view on what a fintech, which is headquartered in its country, what the contribution of that fintech is to the big value chain and the big flow of funds that it's passing through this particular fintech. So I would argue, at least in the European context, take the banking union as a model and also make sure that supervision is indeed, as a first step, taken to the European level, which is basically an intermediate step to move towards the global level. But at least in Europe, we have a precedent, and let's take that forward. I'll leave that at this for now. Thank you.